Welcome, it's the Market Sniper. How are you doing? Yes, indeed. We're going to give you an update on a couple of things, specifically our view for silver and why it goes down first before it has any chance of going up. What could be the reasons for it going down? We have to take a look at the Dixie. 11 weeks in a row up. That is trend change material, my friends. And could we actually even have a further surge of that to come? Of course, Chief Satan Jay Powell will be talking tomorrow, and there'll be some data coming in. And I would expect more of the higher for longer type vibe, because now they're going to actually tell you what exactly they're doing, and then they're going to say, we told you so, establishing alibi, fighting inflation. Remember that thing they never thought was there, and now they see it everywhere? Well, there's that. But let's get straight up to the charts, and why is silver going to potentially go down now? Okay, here we go, charts ahead. So if you're looking at this, I'm showing you the daily time frame. Many of you will know the big long structure. We've covered it at length, so I'm going to drill straight into the action bits over here. I'll take the eye off for a second just so that you can see what's going on. So the last deep dip low was around there at the 19.95. You then got a subsequent fairly meaty rally that took you up to a key level that we've determined before as the 26. Kind of a double top M head there that saw a subsequent breakdown and a run to the lower side. Then not too impressive in a rally. It set up a broadening structure, and then you broke a little lower, down, down, down. But then finally we started to get a little bit of squeezing, and we squeezy Japanesey our way out the top, not as high. And this is where it's getting interesting. We came into what essentially is a key structure. So the key thing about price behavior, and there's a little bit of a learning in here for you, that this is something I've found, is you have to differentiate different pieces across different time frames and clump them together in essence according to their proportionality. So initially, when we'd had this big move up, I think this deserves the fat cokey as well, just so that it really pops for everybody. So I'm going to ignore the double top. This is overall a large move up and then a subsequent move down. A bit of complexity in there, of course, that I'm simplifying down to a diagrammatic level for you. And that was a rejection at the key level of 26. So when I turn the lights back on and you see all these annotations, it'll make sense. But that was a key level of rejection 26. Just run. Always, typically, key level of significance. All the bids get filled. Lots of levels are at there. Therefore, you trade through it because everybody can't trade at the same price. There's a skirmish of activity. You run through and then you pull back down. Very key price behavior point that is fundamental to HVF method. Similarly here, even for your double top, you can see all the buying wicks in the middle point over here that gave you the rally, and then you break with real momentum to the downside. That would have been a key level. Whoops, oh, it's the 25K. What happened there? Just a little bit of iceberging through the 25K and then rejection each time. You see it, there's your sell-off, there's your sell-off. Okay, so a couple of fundamental points, but there's that first impulse. Now, for this to have been bullish, we actually would have needed a nice juicy second impulse of some scale, something like that. And then potentially we could have squared up with a third, and we might have got something along the lines of this. That's not what happened. What we got was, yes, the first big juicy to the 26 level back down to the 22 level. I'm going to be reminding you again why that 22 level was key in a minute. And I think this entire structure is a wind up. But what's actually happened is, rather than this being a first impulse, you can see if I change color that the proportionality of three follow-up impulses are significantly smaller, and they're also more volatile. If you look at the amount of time from there to there, it's quite lengthy. Actually, from the low to this low, it's shorter, and it continued to shorten. And it's continued to shorten, failed to make a very significant high, and is shortening again. So what we're actually getting is faster up and down and less high on the highs. So we're getting a down squeeze compression across those highs, and we're getting very, very strong sell-off. So that was quite a strong sell-off, but this was almost surpassing it. And normally what happens if you're getting an upside setup is you get volatility dissipation. that means it reduces. You get more gradual, so you can be fast up and down in the beginning, but then you get a little bit more chilled on the down leg, and then you get, even more chilled, and you go super quiet, low volatility, and you get a structure like that. That I would be comfortable diagrammatically getting into on the long side. But that's not what we got. What's actually happened is the exact corollary. You've actually had a moderate degree of vol on the way up like that, and then you've gone, listen to the whistles, and then like that. So it's actually got cranky. And what that actually means is this structure is separate to this structure here in its proportionality is separate to that first impulse. And what that first perceived impulse was actually a rally up and then a real trend change event. So what that means is that is a rejection. You got the double top, we've already covered that, between the 26 and the 25 level that brought you down. But in actual fact, you overperformed on that downside, and we reframe how we view this. So what we actually drew and draw, and this is, as I say, a key learning, a reaction to the 26, and then you got what we refer to as a slap in the face event. This is a trend change event. You get absolutely spanked for daring to come up to 26. Bang, slap in the face. You pushed your luck too far with the lady at the bar. You were getting a little too touchy cozy, tweaky, having a look here and there. And she backed you right properly down, and you never really recover. So that is the case of, it was all going so well. You were chatting, you were smiling, winking, all so positive, and now it's gone, you're a creep. You're going down. Okay, so that whole escapade is actually a reversal of events in terms of that. So I love correlating the markets to those proverbial moments at the bell bar. I've actually never managed to push it that far. I'm too much of a gentleman, I suspect. Anyway, jokes aside, this is coming down really hard off a very moderate move up. Momentum is key in all of this. So what is actually happening is we have a very flat bottomed, what we would put forward as a basing ascending grind line, and that is very flat, and actually is part and parcel of our favorite inverted structures, which are for selling to the downside. And can I highlight, markets go down harder, faster, meaner to the short side, and a very bearish scenario that everybody thinks means you're so negative is actually potentially a very profitable scenario for people that understand how to trade in the short side. Ask Mr. Burry of the Big Shorts fame. So with that said, that basing ascending grind line is there. You've definitely got a real squeeze and a coming off across the tops, and that's where we'd say you can place your stop there, and you could look at entering shorts. Our final trigger level would be on the break of that, but you could actually look at early opportunities, maybe even off a wee rally. You could come down there and get a small bounce, or maybe even a bear flag. Sometimes you get that, it depends, and you could try grab on, and that would be your subsequent move. So that's the scenario we're putting to you. It's still quite a fat distance for a stop if you were to only get in long here at the low there, and I'll be giving you those values and the high there. So that's why I like the idea of optimization, getting in short on a weak rally. So you could put a short on there, assuming you were lucky enough that it rallied that far, and you could then have your stop up top there. You could also drop a time frame and take a little bit of extra risk and have an earlier stop that could then squeeze that risk a little bit more. However, then you're not getting the full safety of the reversal point on the third high. And that's something fundamental that we help you learn and teach you in our process of trading HVF method. And that first link in the description, click it, head on over, book a call, have a nice friendly chat, or somebody will show you our community, show you our desktop and our amazing app. And actually, it's all about to get upgraded soon as well. So we continue to invest in our interface with our lovely community and members. So anyway, that's said and done. Where will it go? So let me switch the light on. It's going to get busy now. Cope with it. There we go. Bang, chakalang. 19.88. Now, remember something else that goes hand in hand with this is that when you're running, you're running the 20, but when you're running the 19.88, this is a first structure in a new trend. So there's a scope for it to potentially overperform. That doesn't mean I wouldn't close a large, significant part, well through the 50% on that short. So you can actually trade short and put your profits into purchasing and stacking more silver long. So again, I'm not here to upset our stacker friends. Metals is sound money, and there's no doubt about it. The day is coming for silver, in my opinion, to the upside on balance of probabilities. However, you're going to get made to wait and wait for that bust sometimes. And sometimes, if it's a good trade, you should take the trade. And I think this is a good trade now. Here's what's in your favor. This is a proportional structure as I've drawn it, separate to the big slap in the face impulse, which more makes me assess that that was a trend change event that we subsequently rallied up from. We came down very hard on those rallies, and in fact we continue to come down harder still with each successive impulse, which shows that the bull bid that comes up under the price is being worn down. It's being worn down. All the bulls keep getting filled, keeps coming down harder and faster. The selling is coming across. There's probably some insiders that know something is coming. It could be demand destroying event. Could be, the events of March 2020 recycled with a little bit of a tweak on the theme. Anything we know, who knows, I don't know. But the point is, in charts I trust, and this is a bearish configuration for silver. So short term, we anticipate a run of the 22, the 1988, and possibility for further downside. So I've snapshotted that for you. I want to show you why you might be getting a wind up. You may note this blue dash line at 22, and there's actually a circle around how we supported just before it. So until recently, apart from the head of our once inverted head and shoulder structure, which now we are putting to one side. So we put something on as long as the theme holds. The minute it shows that it's not going to hold and we're getting new evidence for something else, we understand and we pivot and we say there's new forces that are threatening that. So this as a right shoulder I see as less likely, and the 22 we are winding up to break the 22. Why would we need to wind up to break the 22 level? Well, I'll show you, and it requires us to go up a little bit on the time frame. So here we go up there. I'm going to clean my face a little bit and show you why there has been a prominent case for clear evidence of support at the 22. Now it's soft support because it means generally you've wanted to support there on most instances, and even when you have broken it, you've had to break it with momentum. A rule of HVF method is key levels of significance are always broken with momentum unless they are soft reversals like this. So you had the soft reversal on the 26 that I was illustrating. Broken with momentum, rally back. And then the selling pressure came again. And that was a period, a very tough period for metals, where we were below the 22, the dashed blue line. Then you got resisted again when you tried to take it. What happened? Pull back, wind up, broken with momentum. Do you see what I'm saying to you here? And you only had one other event now where you popped through it and you didn't hold for long. So this is the period under which you traded below 22. Otherwise, we have supported, and you can argue in its own way, those two were slightly higher levels of support. So we've had three other events, but now look at the viciousness of that candle coming on the downside on the bigger time frame. So if I pivot that out, change it to pink, you're going to get fresh profits to invest in nice, cheap bullion, silver bullion, on taking a short that will likely see you run the 19.88, which was very close to a level there. Bit of overperformance. You could come a little bit lower. I would certainly close about 75% over there, and I would be very quick to take profits. Why? Because generally I want to be long silver, and overall I'm expecting things to come. However, if we get a disinflationary event, such as a demand destroying event, which we've already seen a lot of rate hikes, and talking about hikes, I'm in my bike jacket now, preparing for tour, by the way. I'll give you updates on that if you're interested, because I'll record and update from the bike each day with a little bit of a chat from the helmet as we charge into Zimbabwe. 36 degrees already there. Oh boy, and I'm actually cold down here. We've got a chilly day here in Joburg. Anyway, that is a digression, but tell me if you're interested to see more on the bikes in your video and share it. It'll be a little bit different on YouTube. This is a worrying sign. Already for us as bagel traders, basing ascending grind lines, we already see this as a bagel break. In short, you could already get short silver, and had you taken it short, we've been discussing this in the community for quite a bit now, and we pivoted fairly recently when we started to see this wasn't going up and this came down really, really hard. you could have actually got short over there. What price point is it on the bagel break? Around 22.91. That already reduces your risk reward in terms of the risk you would take, which obviously expands your reward. Let's do the short position and just show you that, how you might do it. Check it out, Funk Soul Brothers. Yep. Looking forward to that ride, by the way. Looking forward to it on a 500 this time, going smaller and lighter for the sand. Here we go. So we're looking at around, what's the RRR? 4.13. Bearing in mind, you would do a partial close and you would leave open for possible optimization on the residual amount. Now, if you could drop a time frame and optimize that stop a tiny bit more, you could get closer to the 5.99 and a 6. It's not blowout big, not by our standards, but for many other people, 6 RRRs, many of them have never even landed such. So it's pretty acceptable. And it's great return for turning into bullion at a nice cheap price. Once you start to get the choppy bottoming, that was pretty much the behavior that started to come out over here. As you can start to see, a bit thrashy, and that usually points to a bit of a bid coming back in. So it depends what they've got planned for us, how big that crisis is. Are we all going to lose our money in the banks? What are they going to do? What are the dirty little World Economic Forum and their buddies going to pull? We don't know. I don't know. You don't know. We'll wait and see. We're going to smile, laugh, and enjoy life in the meantime, and prepare and try and make some money on the short side. Yeah, we'll see how it goes. So that is my prediction, that actually silver is going to dip down now. It's going to dip down. So we don't look like we've got the stomach for running back up to the 26. Not yet. How do we be wrong, and how does that change? Because, you know, we have spoken a bullish game with the head and shoulder as an option. Let's just remind that, and we absolutely own it. And we always change our views if new information or price behavior comes in. But we have shown you that that was a possible shoulder, and that you may have a head there, and this all could have been part of a shoulder. But this zigging and zagging changes that we feel you're going to break below the 22, and once that happens, you're going to be on your way. That's our triggering point for the inverted HVF. You've already triggered on your basing ascending grind line methodology, which you'll learn with us. That's right. When you hit that first link in the description below and book a call. It's safe and it's easy. You could be building, you could have JP Morgan smashing silver down, helping you get more silver ounces. How about that? And sometimes, yep, I have traded silver short. Yeah, if the setup's good enough, I'll do it. And then I'll turn it into silver. And that's let the market pay for it. And the people that panic will panic in whatever demand destroying event or whatever events will be coming for us on the September-October period. So Jay Powell is going to speak. Jay Powell, I mentioned that as well, didn't I? He's going to be speaking, so we should probably have a look and just discuss this on Forex Factory. That's going to be tomorrow, that it being the fine day of Thursday, September the 28th. So you'll have some German prelim Spanish, but at the end of the day, it's the US information that will move the markets here. So we're looking from 3:30 in the UTC plus 2 time zone, which I am in, and final GDP quarter on quarter. So if that comes in at or better, that is going to be steamy. It's going to lead to more hawkishness, the likelihood of greater increase in rates. I will show you the bonds and the debt market as well. We did do a full video on that, so it's not going to be a recap there. It will just be a quick refresh. Unemployment claims, if that comes in a little bit better to justify, even if it's fake stats, who knows, if it comes in a little better than they expect, they'll say the labor market is red hot, you know, we've got plenty more room for tightening, you know, and everyone's sweating and dying. They're in the sauna and it's 109 degrees and they're de-shriveled and they're begging for a glass of water. They say, more heat please. Here it comes. So yeah, this is quite a funny old pantomime they're putting down on us. This number is Fed Chairman Speaks, Fed Chairman Powell Speaks, and that's where he might say, higher for longer, people need to take us seriously. You've seen JP Morgan recently talking about people aren't prepared for 7% rates and the stagflation that will go with that as part and parcel. Don't forget, JP Morgan, one of the banks that are the owners of the Fed, they themselves owned, of course, by Vanguard and BlackRock, which are themselves owned by the City of London and all the big families that are behind all of that malarkey. So you will be shocked by what they intend to do to the middle classes. And debt is your enemy, as I said repeatedly on the previous clip. And as a result, I will not say to the same degree again. So let's just show you the Dixie as part of this, and then we'll do a run by the debt. Dixie, gold is trading down. It's lost the 1900 handle, so that is a further concern. We didn't show you the gold. Maybe we should do that too. Here we go. Whoops. So that was yesterday, as of yesterday's close, 106.167. Boom, chakalak. 106.5, friends. 106.5. Let's just take the eye on that. So here you are. These are weekly chart of the Dixie. And this is rampaging against the euro. Absolutely rampaging. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and a very strong 11 weeks in a row of green. That is absolute trend change price behavior. So you were starting to round out. You then got a final capitulation, boof, and now you are running to the upside. Boom, 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 boom. Super strong like that. So this, you could actually get a surge, a final surge before it weakens. Everyone's going, after 11 candles, you must short it. It's got to have a pullback. No, no, and no. That's just because it's at 11 in a row doesn't mean it can't go. This is extreme economics that we are facing, guys. There's nothing normal about what we do. The trend is your friend. This is an early, fresh reversal. It reversed after running the technical 100. Don't forget, it's gone right up top here. This thing could rip all the way to there, and most of the days, weeks could be green with just a sporadic minor red candle in between. So beware. Beware, beware, beware. This is a very violent move. You were sub 100 here. You're at 106 point, going on 106.6 over there. So, you know, big move. 99.5 to 106.5. That's 7 points in 11 weeks on the Dixie. That is huge. I defy you to find me 11 weeks of up anywhere else in the modern history, actually. This is seminal. It's not even, you know, it is profound. It is a very rare event. And just to give you a bit more opportunity to show me the last time you think you can find 11 weeks, I pretty much assure you, you're not going to be finding it. You're not going to be finding it. Even over here, plenty weeks in between. This is really a seminal degree of movement. You might have to go, well, we'd now be changing to monthly, but it comes a different game there. 11 weeks in a row. I don't think you're going to find it, friends. And we are truly pushing up higher and higher as we speak on this. So the dollar is getting strong. Dollar is getting strong. I promised you the gold. So let's go in there and have a wee peek at the gold. Gold is softening. Our God market for the precious metals, of course. God bless gold. Yeah, in gold I trust. Well, it's selling off harshly. And I want to highlight here a couple of things as well. So we didn't do a long period of analysis on gold, but we did have 2 points over here. You can see this in much the same way as I was highlighting that the 26 was a real point of rejection for the silver and a potential slap in the face event. It's in gold, it's almost more explicit because it was in 2020 of September. Don't forget the events of March 2020 were there. You had your dip and it absolutely shrugged it off. That was the period we suggested you be long gold, short oil, and that was one of the most powerful extreme delta trades you ever could have had. We then ran up to September and we've not got that level of muscle since. That is what has happened. 3 hitouts on that key point every single time. We've not held above. So we're going to have to pull back and wind up again to see if we can do it. Last time we pulled back to here, we came back up. The Fed only raised, and we were bearish and we were wrong. We were bearish during this period. We felt it would go down. The Fed only raised 0.25 when everyone was expecting a whole bunch more. Market broke up, had another go. Then they started the real hiking. Then down came the down move. So we were wrong here and it went higher. But again, it was rejected at the same place. Rejection. And now after that deep dive to the low ends of 1570, which took you past the, you know, the in the middle of the events surrounding March 2020, roughly around the middle there, came back, maybe a bit more, top third. And now we've been selling off, and we're selling off, and we're having a potential for a little bit more of a down leg, and we are running that localized low. So that means we have let go of the 1900 and we are going to have a deeper dip. A deeper dip. Where will we turn? Will we turn here at the 1810? Will we turn here at the 1730? These are localized points. There was also quite a lot of basing. I've highlighted many times before that the 1640, I think it was, level 1650, 1640 range was a very key one as well. So those are a couple of the levels. You resisted there just before the events of March 2020. You came back on it and kissed it in support there. You kissed it in support there. You kissed it in support there. You kissed it in support there. You're getting a lot of kissing going on. Maybe it's not going so bad with the lady at the bar after all. But anyway, yep, there you go. Down, down, down. So is 1690 stroke 1700 is going to be. Depends how big the demand destroying event will turn out to be, guys. And the truth of the matter is I don't have an answer for you on that, but we do have a target on the silver. We don't so much on the gold. We can drop down into that gold and have a little bit of a closer look, but you are about to run a relative low there, and that's generally not a positive thing. So let's see. I wouldn't say there's a very clear technical pattern of any kind in there. Again, you're basing a ascending grind line broke over there. That was quite a bit earlier. You had a bit of a squeeze there. And you are in Dow theory, unfortunately, of higher, my apologies, lower lows and lower highs. And I suspect we will go for lower lows as we are already matching that. So in some sense, this line ends up somewhere. And it has been quite abrupt. So it's quite interesting that the anti-fiats are getting battered. And the one thing that's actually had a little bit of upside today was Bitcoin. But I don't think that it survives for too long, as long as the dollar continues to show its muscle. So we'll have to see, because I treat gold as the king of all anti-fiats. We could refer to him as God market of anti-fiats. Of course, silver is responding now, and it could be a case that the crypto markets and other things will do the same. The one thing that is diverging, seeing as I mentioned the short oil, long gold, is that energies are definitely doing just fine so far. And it's something else to watch. So you look at who's the relative strength in the commodity cycle, and it clearly is in gold. And you have a look at WTI. Yes. And you can see that it's back up in the 90s after a small dip. And it's actually 92. That'll probably see Brent a couple of dollars on that still. So as long as this is still going up, the risks on inflation are getting higher. The need for higher rates are going to get higher. And until a real nasty demand destroying event, or an event that crystallizes everybody's thoughts into absolute fear and paralysis comes, which will then reduce the amount of oil going, this looks like an up. And unlike gold, the recent trends are higher highs, higher lows. And now starting a new higher high. Again, already at or passing this, you would expect a line somewhere up here on the upside. So we actually have a divergence now in the commodity markets between gold and oil. And that's one that gave us our key trade way back in 2019 that saw the events of March 2020. So you might ask, let's divide USD WTI by XAU USD and do the relative assessment. We'll go with Rwanda and divide it out, and you will see that you are getting clear relative strength out of oil in comparison to gold. So this is quite a strong comparable reversal. Now, I don't want to include the events of March 2020 because that, of course, went to infinity. What a trade that was. No one would have ever thought that you would trade naught or, in fact, negatives. But you can see this was a bit of a turning here. Nice continuation pattern for the relative valuation between the two. You've got to always check what structure you're in. Are you in log? Yes, you are. We want to stay that way. And we'll go here. So nice little continuation pattern, uppity, uppity, up. And then there was a little bit of a concern. So there was a period in June, July, I warned that you could get a bit of softness on the energies. It was round about here when you had that as head and shoulder, and you'd already had a smaller head and shoulder. This one performed to the downside. So we did say, be careful on energies. And it was reversing, but then it stopped, based, turned, and now it is dominating. It is dominating. So oil is dominating. Energies are dominating gold and silver, precious metals. So the need for energies is higher. Gold and silver as money or an alternative to fiat currency gets reduced when interest rates are going up and you're closing the negative real interest rates to inflation. Of course, they'll tell you that the Fed rate is already higher than inflation because they're lying about the inflation number. But the other thing that we mentioned in the previous video is debt is getting destroyed, money is getting destroyed, and that causes selling liquidity in things such as precious metals and in due course, I think, Bitcoin, as a result of that. So that's part of the problem. Bond market is going down. Bond market is deflation. Everybody thinks, oh, the equity market's just fine. They don't care what the bond market's doing. Well, actually, you're seeing money being destroyed because the value of debt is going down. We touched on that in the other video. And just as a reminder, if you didn't see it, one of the best benchmarks is TLT, which is a long-term, 20 years plus, and obviously 30 years. It's a mix of ETFs. And this is what's going down there, friends. If you thought it was going to get better, I've got news for you. It's getting worse. We did say, hit the like button if Market Sniper did tell you. 3 years before it happened, before anyone else even spoke about it. We deserve a little bit of love for that. But hey, we get plenty wrong too. It's not about being right. It's about making money at the end of the day. This is your perennial short at 89, and it has absolutely run that low, and it had a very weak bounce over there, and now it's spilling through that. Debt is devaluing, and the corollary of that is the expectation of rates is increasing. There's not enough true yield paid. There's way too much debt. It's not worth holding. Everybody is seeing it as a negative real interest rate return still against the true inflation that is higher than what you're being told about. They're creating too much money. That means for every bit of new money they create, they're creating more debt. They're getting less tax receipts because they're killing everybody's real estate market, they're killing everybody's crypto market, they're killing everything. People are feeling poorer, they're harder hit, they're being taxed more, and yet they're getting insufficient income, and they keep wanting to spend for the woke topics of whatever, wind farms and transgender rights. And what that means is they need more money and they have to keep issuing new debt, borrowing money into existence. And the rest of the world doesn't want to buy USD treasuries anymore. Oh dear, Fed doesn't want to be the only buyer. Well, I'm afraid they may well be. So that's what's happening. It's kind of like a Bank of Japan situation, and the debt market is contracting. What that means is those assets are reducing. The asset that was created when you borrowed money into existence is reducing. That is disinflationary. That is causing pain. That means money is dying in its relative worth because the asset and the liability, money is dying, its buying power is dying, and the only way you correct for that is you pay a much higher yield. So that actually there's real value in saving in those instruments. Otherwise, no one's going to buy them. And those yields have to go a lot higher for the inflation that they created, the trillions they gave to banks, the trillions they gave post-March 2020, etc., etc. So with all that happening, initially it's bad for metals. Initially it's bad because it's disinflationary. People need cash. They sell the liquidity. Something that will always get close to spot is your precious metals and your bullion. And so the forced and the soft hands and the weak hands sell. They sell. It's easier to sell a couple 100 ounces of silver or gold than it is to sell your house than you live in, especially in an environment where interest rates are going up and the willingness for people to buy is reducing in the property market. Okay, so we've given you quite a bit to think about there. Silver down is the key call that we're making. Silver down first. So remember, I get a lot of comments, but you said silver's going to go higher, and you said gold's going to 2,900. Yes, we still say it will. Time frame analysis, macro charts, monthly charts, setup structures, as yet they haven't been invalidated. The big continuation structures haven't been invalidated. The inverted head and shoulder has been invalidated. I'm calling it before it's even happened, because I think we're going to break down and we're going to run that. But if you look at the bigger time frames, you are still in the likelihood of continuation. I just can't tell you when. When do we break this next? Well, you have a down leg there, you have a down leg there. What will we get here? I don't know. What kind of continuation will it be? Or will it be some form of structure like this, we're still waiting to make a right shoulder and back up to the 2000 levels, and then we break. Who knows? Who knows? I can't tell you, but we are due a pullback. That's what the market is showing us. We're taking out lows. You can't ignore that fact. Long run, the overall continuation from where this pole planted in here in this is suggesting the 2.9, and that doesn't change even if it comes down here, even if it comes down there, even if it comes down there. So for quite a long time, that macro remains. It only is triggered, however, when you break through that to the upside, and that looks like it's being pushed out as a date. So we are looking across time frame. So it's quite simple. You can be short on a low time frame, such as 4 hourly and daily, and on a monthly be long. This is known as multiple time frames of analysis. It's very rare you get a set of circumstances where the 1 minute, the 30 minute, the 4 hour, the daily, the weekly, the monthly, and the upside are all red or all green. You often have different trends active at different times. So we are talking out of time zone. So for all of you about to leave comments, but you said, understand multiple time frames of analysis. Macro remains good. You can have a pullback, and it's also okay. It just means the likelihood or the event or the delay could be longer before your macro. However, as fast as it falls, sometimes it comes back even faster. We actually need movement. That's what we truly need, and it might go down first. Sometimes the winding up process to go higher requires a down leg. You need to understand there's no such thing as bad price behavior. Every great upside HVF, something similar to this, has had 3 down legs. There, and there, as part of the function that then gives it new, fresh energy to make new highs. Understand that as principles. So this is part of the good stuff that you need to generate the force that's going to be giving you your 2,900 in the future. Okay, I hope that was interesting to you. That's a precious metals update from yours truly, the Market Sniper. Don't forget, book a call in the links below. You can trade with us in and implement HVF method, and dare I say it, you could even make profits on the short side on silver and turn it into bullion later, only to be seeing it go beautifully up to the $45, $50 range and having more of it. What's wrong with that? You are not breaching the team and spoiling it by going short. Guess what? It's going to do its down leg whether you're in it or not. You are not the driver of the market. You are but a rat, a mouse, or a flea in the market, and that's okay. God bless the fleas. Okay, but on the way up, you will have more of it when it goes around. So we'll see you next time. Thanks for watching. God bless from the Market Sniper, and watch out for the tour from Joburg all the way, Kariba, Victoria Falls, through the sand, with a rowdy pair of fellow bikers, plus a mystery guest of someone you might know. Have a guess below who you think will be joining me, that I've yet to meet in person before, but you will have seen on YouTube. Okay, till next time, I'll catch you later. Shares is love for us, and we appreciate it. Bye.